Gotcha. Good morning and welcome to the latest in the IMAP webinar series. It's a pleasure for us today to be joined by Vinnie Wadhera from BetaShares, Wade Matterson from Milliman's. We'll be talking today about strategies for managing investment risks in managed account portfolios. But before I hand over to Vinnie and to Wade, I want to talk a little about a couple of the things which IMAP has coming up over the next couple of months as part of our program for conferences and events to help advisors and portfolio managers to make excellent decisions about the way in which managed account services are developed and offered to investors. So I just want to talk briefly about the Portfolio Management Conference, which we have coming up on the 2nd of August, and a little about the awards, the closing date for which is later this week. So let's talk about the awards. So the goal of the IMAP Awards, Managed Account Awards, is to identify and to recognise best practice in managing portfolios. What I've done to try and identify and recognise that is assembled a panel of independent researchers, as you'll see on the screen: Angela Ashton, Nigel Douglas, Brad Matthews, Dominic McCormick, Mark Oliver from Macquarie, who brings a platform due diligence perspective to it, and Stuart Alsop from FE, who are our data collection partners. Together with them, we've identified a number of categories in which portfolios are managed, and we'll be assessing the entrants over the next 2 months. You can see on the screen that there are a set of investment-only classes, so Aussie equities, small caps, international equities, multi-sector, fixed income, other asset classes, but perhaps most important to me is the single AFSL portfolios. So this is really a chance to draw together the beliefs that an advice practice has about investment markets, their investment philosophy as they express it in their advice service offering, and the way in which that dovetails with their managed accounts, the way in which they've managed to use a managed account program to implement their advice service offer. So I'm really excited about the advisor or licensee portfolios. And the last category is innovation. And I can tell you from the entrants that we've already had, there have been some really interesting views on innovation. We've drawn the brief for that very broadly. It's the thing which you're doing in your organisation that you think assists the development of managed account service offerings. Entries this week, then over the June-July period will be the judging panel will be evaluating them and arriving at a set of finalists. In mid-July, we'll announce the finalists, and then the awards themselves are in the evening of the 1st of August. So look, it's late in the day, but if you think that what you do in managed accounts represents best practice, I'd encourage you to go to the IMAP website and submit your entry to that. The other point I wanted to talk briefly about on the following day is our Portfolio Management Conference, and I've listed a number of the topics which we'll be covering in the Portfolio Management Conference. This is the second year we've run this, and it really reflects the fact that managing portfolios when the outcome is a managed account program, quite different from either managing pooled investment vehicles like unit trusts or delegating to advisors the portfolio management decisions. And in the Portfolio Management Conference, we really try to draw out the key features about portfolio management when the average account size is going to be 300,000 or 700,000. Some of the constraints that faces, that gives rise to. So today, managing investment risks as I say, it's my pleasure to introduce Vinnie Wadhera and Wade Matterson from Milliman and ask them to talk about managing investment risks in managed account portfolios. So over to you, Vinnie and Wade.
Thank you, Toby. Thank you very much for that warm introduction. Look, we at BetaShares are very proud to be a partner and supporter of IMAP and the education work that IMAP does on managed accounts. Now, it's interesting, managed accounts are, and the efficiencies that they bring to an advice practice are predicated on, technology, processing power, and evolution in IT. And the same can be, look, the world of investments is no different, investments and investment products. The world's stock exchanges have invested significant amount of, investment, R&D in their own processing powers, their trading systems, their settlement processes, whereby now, like for example on the ASX, we now have a T+2 settlement and a transfer of assets that can occur. And what that also means is that this humble managed fund and a unitized fund has evolved into a number of things: exchange traded products, exchange traded funds, LICs. Investment exposures now are quite diverse. The underlying investments that are very easily accessible now through a simple share trade span across passive indices, asset class exposures like currency, gold, smart beta exposures, and the really interesting development over the last few years have been strategy-based exposures and active management. We at BetaShares call this the democratization of investing. That means that certain exposures that were difficult to access are now very easy to access, as simple as a share trade. And secondly, strategies that were only the domain of institutional investors are now available to all investors. Now, when you marry that accessibility and what's available now in a listed format, when you marry that up with a managed account, it can actually be a very powerful and effective combination. It makes investing frictionless, particularly where strategies were only available in an unlisted managed fund. You don't have to fill out application forms, and you're not restricted by menus either. And what I'm really heading to is that no matter what your portfolio construction philosophy and investment views, there are now listed products and exposures that can meet your building blocks or be your building blocks. Whether your philosophy is passive only in terms of asset allocation or passive underlying, whether you have an absolute return focus, dynamic asset allocation, or a bucketing strategy, there are building blocks and solution available for you to build robust portfolios in a managed account framework. So if Toby's asked me asked Wade and myself to focus on managing investment risk itself can manifest itself in different forms. And what we'll focus on today, and look, this is not meant to be a product promotion, and I'm very conscious of that. However, due to the unique nature of some of the BetaShares exposures, I will be referencing some of them as an example. And the three areas that we want to focus on and highlight to you today in terms of portfolio construction and managing investment risk are the three areas on this summary slide that were in the invitation email. That is managed risk investments. Secondly is diversification within asset classes and income streams. And thirdly, investment exposures that are relevant for market uncertainty, volatility, and to implement risk-off views. So let's start with number one. And to really lead the discussion with me is Wade Matterson. Wade is the practice leader for Australia, New Zealand for Milliman. Milliman are a global actuarial consulting firm and risk manager. And I should just distinguish, a risk manager is different to an asset. They're not an asset manager or a fund manager, they're a specialist consulting firm. Wade, welcome on the call.
Oh, thanks, Vinnie. Pleasure to be here.
We at BetaShares have spent quite a lot of time in terms of research and looking at this space of retirement portfolios. A few years ago, we published a paper the case for managed risk investments. And in this, we looked at the requirements for retiree portfolios. We looked at demographics. We looked at the nature of markets and how diversification alone may not be a plausible solution for retirees. A lot of the findings that we put in this paper, and I'm not going to run through them all, are really summarised around, look, these 3 points. And many of them won't be a surprise to you. In terms of, we're at historical cash and bond yields at the moment. So retirees have a risk there of outliving their assets. They can't just rely on those low yield levels. So there's that introduces longevity risk. Equity yields are much higher and better. Retirees need to experience some growth and some moderate levels of income. But equities also are risky, so that brings about this concept of sequencing risk, which is very prevalent in market drawdowns. And tied with that is this concept of investor behaviour, of what investors may or should not do during those drawdowns. And I just thought to invite Wade along, because given their specialty in this area and the amount of research they have done, I thought it might be useful for him to share some of their findings and analysis, because we really used a lot of that as a summary for our own paper. And again, that's available on our website. Wade, I might just throw over to you to really just highlight some of those key points around longevity risk, the nature of markets, drawdowns, and sequencing risk.
Yeah, sure. Thanks, Vinnie. And again, thanks to Toby and the team for inviting us to participate. So I guess just to start from the beginning, and the context of Milliman as a business, we've worked with large-scale institutions to help them manage risk from a balance sheet perspective for decades. And over the last sort of 10 years we've been in the Australian market, we've focused primarily on the retirement problem. So how do people, fund the retirement lifestyle that they desire once they're no longer working? And I guess the crux of the problem as we look at it is, whilst we're accumulating and we're saving for that day in the future where ideally we then embark on this long and fruitful retirement journey, the problem's a very different one. So we're focused really on maximising my return, so the pot of money at the end of that working life is at a peak. But as I get closer and closer to that retirement date, then it's less about return management and it's more about risk management. So there are a whole variety of things that can take the best laid retirement plans and essentially create a whole range of problems for them. So clearly, how investment market returns sort of influence my retirement journey is a really key factor, and the one we're going to focus on today. And the reason it becomes so important is because inevitably retirees face what we refer to as this risk return paradox. So we're now living longer and longer than we ever have historically. So retirement is 25 or 30 year time horizon, and yet I'm not working to the same extent as I was prior to retirement. So if anything happens to the detriment of my retirement savings, some of the really key levers that I can use, like work longer, save more, are no longer available to us. So we have to be really conscious that the risk of market drawdowns can become quite pronounced and have really detrimental effect on retirement savings. And I think as we've thought about historical kind of portfolio construction techniques, we've been very, very focused as an industry on focusing on long-term investing. So the asset allocation approaches typically are very static, stable. We may use things like bucket strategies, for instance, to try and manage the cash flows over a period of time. But what happens if we look historically at the impact that market drawdowns can have? They actually happen with a lot more regularity than perhaps most people think. So on this particular slide here, we're just purely looking at Australian equities. And some of the key statistics you can see there is since 1935, for instance, there's 13 events just on Australian equities alone where the falls have been over 20%. And so that's a really sizable hit to anyone's retirement savings pot. And as you look at each of those events, the period that it's taken markets to recover can range from anything from, just over a year to, 4 or 5 years. And so again, like the question we really sort of sought to address was, how do we build investment strategies that recognize these risks exist and actually seek to actively manage them rather than rely on purely timing the market? The next slide goes a step further and basically shows you a similar type of analysis beyond the Australian equities market, and looks at global equities, and can show you, quite clearly that markets go through these long extended periods where they're on bull runs and performing really, really well. But then when the correction inevitably comes, it can take a long period of time to recover. So again, you can see internationally in the 2000-2002 event, that correction took place over 2.5 years. And that was the classic tech wreck. The financial crisis, again, took 2 years from peak to trough. And then we've had these sort of bull runs that we're now in the midst of, which has been running for almost 6 years on the international scale. Again, a step further, this is the same sort of information, but presented in a slightly different way. If we look across a range of different markets, you can see this sort of scattered view that market corrections of serious magnitude are quite prevalent. And so the real challenge ultimately, is kind of across those dimensions Vinnie mentioned, that if we're trying to have retirees set up their portfolios so that they have these long lifespans to them, and they obtain the types of returns that they need to keep up with their purchasing power and provide income in retirement, how do we do this in such a way that when these inevitable big hits come, that they're not impacted detrimentally? And I think we'll talk a little bit about the behavioural impact, because it's one thing to look at returns and performance, but the other thing we have to consider as we start to build these types of portfolios is when we look at these types of paths, is that the investor return that they receive is actually never the same as what you see come through in the market, because inevitably investors will trade during periods of market volatility to their own detriment, because they will sell, they will buy high and sell low, when we all know that we should be trying to do the reverse of that.
And Wade, just another point, for those in pension drawdown phase, their returns will be even lower because they're drawing down in a down market.
Yeah, absolutely. So I think that's another classic example where, again, a typical strategy might be to try and take 2 years of cash and put it, 2 years of income and put it into cash, for instance, and then have the rest of the portfolio allocated to more growthy type assets. But as you've seen, like, these corrections can extend well over 2 years. So, inevitably you will end up with scenarios potentially where you've drawn down that cash that was set aside for that sort of safety net, and now I have to dip in to the growth assets, which have been exposed to this correction. And I would also kind of challenge that classical strategy, because given an environment, do you really want to have to wait for markets to recover? You actually would be much better off in the first place if, when the correction happens, those growth assets don't experience the size of the correction that the rest of the market has experienced. So there's a few ways you can sort of think about it. And so this slide's really just trying to highlight and illustrate that the timing of that correction is really fundamental to the impact of a retiree in particular. And it depends very, very much on where you are in your financial journey as to whether it's something you should start to sort of consider as you build portfolios. And so what we're showing here is we're showing, a hypothetical sort of set of people from their 20s going out to, 100 years old. And we're running kind of one baseline, which is the red line. And then we're shocking it by 30% at age 30, and that's the blue line. So what you can see is the red line, which then becomes kind of black later on, left to its own devices, the money will last till well over 95. Now, if I take that same trajectory and I encounter a market shock of 30% at age 30, what you can see is it costs me maybe 5 years of retirement income, because the shock has happened so early that the person's actually been able, through the benefit of contributing more and more money to their retirement savings, they've been able to buy in at a lower price, and actually it's been somewhat beneficial. It still has had an impact because it's hit some of their early returns, but overall there's only a handful of years that they've lost. Now what happens is, if we fast forward and look at the sort of the larger drop at age 65, we're applying exactly the same shock. We're applying the shock to the person at 65 and to the amount that they've accumulated at that point. So you notice two things. First, that the size of the drop is much, much greater. And the reason for that is very simple. It's because they've obviously accumulated more assets, because they've now at the end of their working life, and the pot of money that they've built up is much, much higher. And so what this is demonstrating is the size of the return you get as the money gets bigger is more important, positive or negative. And in this case, where we stress it by shocking it with a negative number, all of a sudden you see this big drop in the retirement savings pot. Then when I start to translate that into income, now what you can see is, instead of the money lasting to 95, I've now lost 15 years of income just by nature of that shock at that one point in time. Now, this is obviously a very extreme event, but I think it clearly demonstrates the point that the timing of the returns matters. And so this is kind of back to my original point, that as you get closer and closer to retirement and move through retirement, it's the managing risk effectively and in an efficient way becomes, in some respects, maybe even more important than trying to seek out that extra 50 basis points of return. And again, the behavioural bias that I think, just because it is such an important dimension of this problem, and there's been a number of interesting studies that have been conducted around behavioural bias, and the one I quite often refer to is around loss aversion. And so what loss aversion is, it essentially states that an investor that loses, feels more pain from a loss than they do satisfaction from a gain of the same amount. And so the studies that have been conducted look at the average investor, and the average investor tends to suffer a loss aversion factor of 2 to 1. And what that means is, if I lose $100, then I actually have to win $200 to feel the same amount of satisfaction from the win as I do pain from the loss. Now, in the US, the American Academy of Life Insurers did a study on retirees. And when they studied retirees to quantify their loss aversion factor, the factor that they uncovered that they experience is actually a factor of 5. So whilst the average person suffers a loss aversion factor that is 2 to 1, a retiree suffers a factor that is 5 to 1. So I now have to win $500 to make up for a loss of $100. And so the reason that kind of relates to this chart is, what we've done here is we're highlighting that in the financial crisis, for instance, what people often do is they'll look at an investment that has a risk management mechanism to it, and they'll compare it to the investment that doesn't have it. And we know there's no free lunch. So when markets are going great guns and everything's outperforming, a risk managed investment has to underperform an investment that doesn't have that type of safety belt inbuilt. But the reality is, when the crisis comes about, investors will actually often switch to more conservative investments. So it's really a question of what is your benchmark. And I think, using that loss aversion sort of analogy, the classic investor, their loss aversion their benchmark in a bull market is 100% growth, and their benchmark in a correcting market is 100% cash. And so what we're trying to demonstrate here is, if you look at this sort of kind of trade-off that investors actually make, they're trading off between this really conservative investment, which is what would happen when people switch out and they sell at the worst possible time, versus if they had have stayed invested in the growth asset all the way to the end. And I think that's really what risk management's trying to do. It's trying to create a smoother journey that encourages people to remain invested throughout all market conditions.
Thanks for that, Wade. And that was a good summary of the type of investment risks that manifest themselves in pension and drawdown portfolios. We'll now move to just some of the solutions that institutional investors have been using for many years and what's now available for those that are constructing portfolios. But before I do, I think it's just worth highlighting, Milliman themselves published this paper back in a few years ago, back in April 2016. It really caught our attention, Wade. We've actually highlighted it to a number of our clients. And I think it's just very concisely put of that diversification across asset classes may not serve the purpose that it should be, particularly in market drawdowns. Could you just on that point itself, just highlight your observations and the analysis that you did on that?
Yeah, sure. So I think what I really struggled with when we began thinking about how to, produce a framework for thinking about risk management is this idea that sort of diversification is really the only way to deal with this problem, and that it's effectively a free lunch. And I think the challenge with that in some respects is it ignores this whole sort of aspect of where we are in any particular cycle. So if you were to look at the classic kind of diversification instruments at the moment, which are fixed income, you'd have to kind of begin to question whether the risk to fixed income is actually that interest rates are going to rise a lot more from where they are now, or how much interest rates will actually go down. So there is that kind of dynamic. The diversification is the bedrock of risk management, as we've outlined here, but it's not perfect. And it's not perfect for a whole range of reasons. And so as you start to think of it in this kind of pyramid context, we wanted to begin to plug the gaps. And so as we, the first thing to us was, and the way you plug these gaps is you need to sort of start to plug them in giving consideration to the cost and complexity of adopting that risk management technique. And so, we've put diversification as the bedrock because it is a really, really inexpensive way of getting some basic risk management in your portfolio. But as we know, when it relies on things like correlations don't always play out when markets go into crisis, and assets can correlate to one really quickly. So we, think of risk control as the next natural layer to that. And what we mean by risk control is you're using rules-based approaches and really cheap sort of instruments, exposure management instruments, to provide elements of protection and control for volatility. So we want to try and control when volatility spikes, and we want to have some aspect of downside protection that isn't hugely expensive. The next layer up is where we start to bring in instruments that probably are more familiar to people in terms of providing protection, but they are more expensive. And so as they become more expensive, designing strategies where they're always on can occasionally become detrimental. So we've allowed for option purchases that sit on that layer above the basic risk control and diversification elements. But even then, option purchase doesn't necessarily give you an absolute guarantee in some respects. So then what we've done is allowed for another dimension at the very peak of this, which we kind of refer to as catastrophe protection. And then that is where you're seeking out an absolute guarantee across loss of income or capital. And again, given the pricing, you have to really begin to think, what are the right types of people that we're dealing with that may benefit differently from each of these different layers, and how do I use them? So our view is typically, as you begin to move up this pyramid, you're going to use those types of risk management mechanisms more sporadically rather than have them on all the time.
Thanks, Wade. Now, I've asked Wade to mention that because on the ASX, and we have partnered with Milliman, is to actually have a solution available to portfolio constructors to meet that second level of the pyramid, a risk control equity solution. And the two available funds on the ASX are AUST, that's the ticker code. So that's a broad market Aussie index that has volatility management and risk control, and our global equity passive exposure, which has the same risk management and volatility control. And it's very interesting, the risk management strategy that runs as an overlay on these funds, and we'll come to some of the outcomes and the modelling that it produces, is the Milliman risk management strategy. And it's the same risk management strategy that numerous institutional investors, insurance companies, pension funds, endowments, government funds around the world use. And this comes back to that example about the democratization of investing. This risk management strategy that many institutional investors around the world use is now available in a very accessible way to all Australian investors on the ASX. And the other interesting thing is that insurance companies in particular, when they have a risk management strategy like this in place, have the potential to actually receive relief on their capital charge that regulators require. And the reason why a regulator would allow that is what is happening here is not like a hedge fund trying to generate alpha. It's addressing a particular nature of markets. And that nature of markets is really highlighted in this chart here. Wade, do you want me to run through it, or do you want to run through it? Let me do it, and then you can do the secret sauce. So look, this chart is interesting because it shows the ASX 200 over time. Periods that are in green are periods that are normal than average volatility. Periods in peach are periods of higher than normal volatility. And there's two interesting things here. We've put the grey bubbles over periods that correspond with a period of higher than normal volatility, and the market has either pulled back or drawn down. And you can also see another interesting thing is that volatility is clustered. There are periods of green, periods of normal, periods of peach. The risk management strategy that we've highlighted here addresses that nature of markets. It looks at the clustering effect of volatility and the direction of volatility. So as volatility is rising or spikes, the risk management strategy hedges the portfolio. And when volatility subsides or is normal, the hedge is removed. So it's a variable hedge. And that itself produces a very interesting outcome for equity portfolios. Wade, anything quickly you wanted to add to that?
No, I think that's a good summary, Vinnie. As you said, really it is those scenarios where you see market corrections really strongly correlated with increases in volatility, which is intuitive if you think about it, and that's what we're trying to protect against.
Sure. Look, we can follow up with anyone to go through the exact mechanics, and I'm happy to have Wade involved in that discussion if you want to run through the exact calculations, or if you want to run through Milliman's 180-page RFI document on the calculations, we're happy to provide that too. But I think the key point is that this risk management strategy is one that's used by insurance companies, institutional investors around the world, and has served them very well. I'll run forward in terms of just some of the outcomes this produces. On this chart, you can see a global equity index, right? That's the grey line. That's an MSCI World Index over a very long period of time, I think an 18-year period. The orange line is the same global equity passive index return with the risk management strategy. And it's interesting, you can see what's happening here. It's, your annualized return over a long period of time is pretty much on par, but it's being delivered with half the level of volatility, 14.9 versus 8.1. And you can see that you're just not experiencing the severity of the dips. So this goes back to addressing some of those investment risks that Wade highlighted earlier about being in growth and risk assets. So it's allowing, and the next slide actually is very interesting because this is the drawdown analysis of the MSCI World versus the risk managed indexed fund. And you can see the severity of the drawdowns are much less. And you can see that, as Wade put it, that risk control. Look, we make the analogy of a decelerator, accelerator, decelerator, and a hard handbrake in certain market environments. So you're just not experiencing the drawdown, which means your time to recover is shorter. And for those in pension drawdown phase, that can make a big difference. Now, the other interesting thing, if I go back now for portfolio construction, is that we do a lot in terms of model portfolio construction and analytics. It's interesting, in an asset allocation optimizer, if we were to place in that optimizer our international equity index returns as the orange line rather than the grey line, so it's the managed risk passive global equity index, it actually has a very interesting outcome in an optimizer. And that is, for any given level of risk, you're actually achieving a higher level of return. And the reason why is because of that volatility number is lower. Your variability of returns is lower. So using a managed risk equity, global equity exposure as your equity index exposure allows a more efficient portfolio here. Your portfolio is shifting to the left. So we've got a lot on the modelling on this, and we're happy to share that if anyone wants to run through more details. Wade, any other final comments on that in terms of effectiveness in portfolio construction?
Oh, look, not particularly. I think that, hopefully it is relatively intuitive that when you're thinking about what's really happening here is, the classic investment portfolio gets dominated quite significantly by the fat tails that exist in equities when we think about return distributions. And so what we're actually doing here is we're sacrificing some of the upside by the nature of the risk management strategy. But the benefits we're getting from truncating the worst of the worst outcomes actually end up giving you improvements across the board. And so then when you think about the sort of retiring investor we're talking about, and again, bring it back to that loss aversion behavioural aspect, that loss aversion and the utility that they gain from losing that fat tail is really significant.
All right, so in the interest of time, we might move on to parts 2 and 3, which I promise will be straight to the point here, but I think it was worthwhile just going into that detail. And look, we have a lot more detail in terms of the actual analytics, the work that Milliman have done, and some of the outcomes of the managed risk exposures. So please feel free to reach out to us or via Toby, and we're happy to run you through those details. In the time that we have, I just want to touch on points 2 and 3 also, which I think are very important for managing risk and particularly looking at income and diversifying your income streams. So this is within asset classes. And particularly for those in retirement portfolios. On the equity side, it's very interesting because there's a very heavy reliance on dividends and franking credits as part of your income generation. There are other equity income sources. One very well-known one, and one that's being utilised by managers and even private client advisors, is what's known as a buy-right strategy, where you're generating option premium income over the stocks that you hold. A few years ago, the ASX commissioned a paper by Sydney University. It was published in 2012, and it was a landmark study that actually demonstrated that even a rules-based buy-right strategy, and they looked at a number of different buy-right strategies, rules-based ones, over a long period of time, outperformed holding just the shares themselves. And we have actually put in place one of the key strategies from this study in a very well-known and popular fund of ours, the YMAX fund, the Top 20 Yield Maximizer Fund. This one, quite simply, look, we've been running this fund for five and a half years now. It has some well over close to 400 million of assets in it, and it's proven to deliver on that diversifying your income stream within the fund. The running yield on this fund has been around about the 10.5 mark on a running basis since we launched the fund 5 years ago. And when you compare it to holding just the top 20 stocks by index, you can see the difference that the buy right strategy is delivering to the fund. You know, it's an additional, you know, around about 3 to 4% it has delivered over and above just dividends and franking. So there's just one example of looking to diversify your income streams just from dividends and franking. Look, another interesting one, and particularly in a managed accounts framework, is very interesting, is just simply asking the question, what am I getting on my cash? You know, we ask the question, and your clients ask the question, what am I paying on my home loan interest rate, or my mortgage rate, and to call your bank and to negotiate or ask for a better rate. I think the same should apply on your cash holdings too. It's interesting, we have compared, and look, this is one of our larger funds. It's the only cash deposit ETF since we launched it some 6 years ago. It has 1.3 billion of assets in it. For many, it was their first time ETF investment. And I know many of the institutional investors, and it wasn't because they were looking to invest in an ETF, it was because they were looking for a pickup in their cash return. The current cash yield on this is 2.01 net of fees, and we've just done a comparison of how that compares with other various cash holdings. You know, sure, you can probably get some TDs a little higher than that, but you have the additional admin burden of rolling the TDs and locking up your money. But it's worth just asking the question to make your cash work harder and to get a pickup on your cash rate compared to what it currently is. So there's one quick, easy way to pick up your income. Another very interesting one is just looking the next level in terms of the capital structure from cash at bank or TDs. And the next level in the capital structure is floating rate notes. Floating rate notes are, particularly with the banks, the big Aussie ADIs, have regular issuance cycles, and the other big advantage is they are pegged to BBSW, so they're floating rate. The rate paid on the coupons ratchets up as rates rise. So it's a good way to immunise your fixed income part of your portfolio during a rising rate environment. Again, look, our coupon fund has become the point product because many fixed income analysts have identified the index methodology is in the most liquid bonds. The running yield on this fund is, sorry, I go a little faster there. The running yield on this fund is that top line, which is 2.9, which is gross. Net of fees, it'll be around about 2.7. And you can see the volatility and max drawdowns of floating rate notes. You're not in cash. It's very important to note that. As soon as you move from cash, you are taking on some risk. And we highlight there the risk that you're taking on is 0.6 volatility and a max drawdown of 0.8. Interestingly, that max drawdown, the historical max drawdown, didn't occur during the financial crisis. It actually occurred during the European debt crisis when spreads blew out. So there's another way to just work that fixed income and defensive asset class a little harder to get a better yield. Another interesting one, and many advisors we come across do utilise hybrids. Hybrids do have both debt and equity characteristics. In recent years, the Basel III regulations require banks to issue hybrids, and certainly they do have a favourable treatment once you include franking credit. So again, they're a diversified and higher up in the capital structure than pure equities. Look, my role here is not to highlight the case for the asset class. I think many of you that have, and your clients that do have hybrid holdings know the advantages of it. What I would like to highlight though, and look, there are risks with hybrids. During the financial crisis, they also did, in a risk-on event, have a significant drawdown. However, I would like to highlight though, is the case for active management in this space. And the active management transpires in one of our very unique funds, which is the HBRD fund. We have partnered with a highly regarded hybrids manager, Coolabah Capital Institutional Investors. And the reason we did that was to really acknowledge some of the inefficiencies in the hybrid market. And the inefficiencies come about because, well, in part, the retail issuances, which may not be priced according to what you may consider your fair value. The pricing ongoing on the ASX is demand and supply based. There is a whole market on the OTC market that wholesale institutional investors access only, and an active manager can tap into that. The other big feature in this is a capital preservation objective, where in those times of risk-on events where drawdowns can occur on the capital price of hybrids, the manager here has the flexibility to rotate higher up the capital structure in FRNs or into cash. The running yield on this hybrid fund is gross 5.34%. How are we tracking for time, Toby? A minute or two?
Yeah.
Great. And finally, I just wanted to highlight is the third part, which is yourselves as advisors and that have total discretion over portfolios. There are now tools and exposures where you can actually implement to manage investment risk. One particular one, so we've moved on from hybrids, Toby. I might just flick through to currencies. Now, that's very interesting. With your international equities exposures, there's two components of the return. One is the equity market return from the actual country of domicile, and the other is the currency drivers, the cross-currency. Now, it's interesting with the way that, and again, the way that the currency exposures that are available in an ETF can be used. Well, there's a number of ways, but really I wanted to highlight was the risk-off exposure. And that's really highlighted in, oh, it's not going down, so I'll let you move that. Oh, yeah, great. The US dollar exposure, this is close to a $500 million FUM of assets, and it's very interesting the way advisors and portfolio constructors use this. And the thesis really is that when you rotate from Aussie equities to cash, you can do that on your international equities exposures too without having to cross the currency and bring it back to Aussie cash. And the way to do that is with a currency ETF. And what it allows you to do is to still maintain currency exposure without the equity risk. Many investors do want to maintain that currency exposure with the way that US interest rates are likely to head, without having to continually reinvest in equity markets, which they may believe are fully valued. So there's a neat way there to take risk off on your international equities. Look, another one that is now available to Australian investors is a short series of funds. And this spans across an ETF, ours, which is the Bear, BBOZ, which we call the Big Bear, and BBUS. But the real portfolio application here for these short funds is your view of markets and the ability to overcome some of these issues. If you were to sell your shares or assets or funds or ETFs, you're going to be losing income. Also on those growth assets. The other thing is you're going to be crystallising a tax event here, which CGT may be payable also. And you may have a well-crafted or well-selected blend of international shares, funds or portfolio, which you just want to see through any medium-term market pullback. These short funds allow you to hedge your portfolio using cash without having to sell the assets or make any movements in the portfolio. We have some pretty neat calculators that have helped advisors to implement their hedge. There is a counter side to this. So so for an example here, $1 million client portfolio that you want to hedge 25% or lock in profits, it just shows you the effective exposure of our BBOZ fund and how much cash to buy those units to put that hedge on. So it's a very powerful hedging portfolio construction. Managing risk exposure. I might pause there and take some questions, Toby, if we have time.
Look, we certainly do, Vinnie. And if you're on the panel and you want to ask a question, you'll find that the ability to put questions in through the website or to chat is on your screen, and I'll repeat those to Vinnie. So I guess one of the questions which has come up is whether there'll be a copy of the slides, and yes, all the slides and a recording of today's session will be available on the IMAP website with luck later this afternoon.
Sure. I noticed one question here, Toby, about a buy right strategy and the price returns of it, which is very interesting. Look, we can actually point to the 5.5-year track record of our WiMAX fund, and that's very interesting. So we can demonstrate that a buy right strategy can outperform holding just an equity portfolio in certain market environments, and those market environments are a sideways grinding market, secondly a moderately rising market, and thirdly a down market. Where it tends to underperform holding just the stocks will be in a very strong bull market, because don't forget, you're bringing forward your income or your potential return on day one and banking that. So we have some mitigation factors, but that's certainly one market environment where it does lag holding just the shares.
One of the questions that's come in, Wade, is for you, and in terms of portfolio risk management strategies, and that is when we look at large institutional funds, the industry funds, they tend to make much more of their exposure to illiquid assets. I noticed, for example, the Future Fund is holding somewhere between 6 and 10% forestry and other similar asset types. To what extent do those types of investments represent natural, illiquid investments represent natural hedges compared to the financial options that we were speaking about earlier on today?
Yeah, well, I think I wouldn't really think of them as natural hedges. I think where you have to kind of consider that within that pyramid that I outlined is it's really an attempt to create broader diversification. So we saw this discussion come out a lot after the financial crisis, where people would argue that part of the problem was that our investments weren't diversified enough. Now there are, obviously, large industry funds can do that just because of their structure and scale, and I'm sure Vinnie can talk about sort of the wide range of asset classes and exposures that you can get through different ETFs. I think ultimately the challenge is, as we start to throw more and more asset classes into the mix, you're actually starting to potentially introduce complexity, and some of those asset classes may not necessarily, you require expertise in newer asset classes, and you also want to start to understand how they're going to behave in a crisis. So the way we have sort of approached it is where you have asset classes that are very liquid, then rather than, whilst diversification is one aspect, you can actually also seek to run a risk management overlay directly on that asset class, so that if it goes down, then the value of the overlay will go up. So it's a really good, generally the analysis we do, combining those two features together by broadening out diversification, but then also having that direct risk management overlay sit on top, tends to give you much better outcomes.
Okay. Another question which has come through is to what extent or in what way can portfolio managers who are running managed account portfolios either through MDAs or SMAs take advantage of, sort of actively manage the risk in their portfolio, given the constraints of platform technology or administrator technology?
Yeah. So Toby, it's interesting. We work with a very wide range of advisors, and it's interesting. We're seeing, particularly in the managed account space, a separate set of portfolios that have been set up for those in pension and retirement phase, which addresses a large number of risks that or a type of client. So that's one category. So they may have their broad model portfolio, but we're seeing a separate one set up for pension drawdown. And then I think the other one is using some of these exposures, whether it's hedging, diversification, or explicit risk management. It's interesting just looking, and I really use our short funds as a barometer. They're the only ones in the market. There's some, I think, close to $500 million across that suite of short funds. Many managed account model portfolios have actually started utilising that just this year, putting in their hedge, locking in profits. So it's very interesting to see that.
Okay. Look, any final questions for the panelists, for Wade or Vinnie? Okay. Well, look, thank you very much for those of you who've joined today's webinar. It's been a pleasure for us to have Wade and Vinnie to talk about risk management in managed account portfolios. Just to close off then, I'd remind you that if you'd like to have your managed account service offer recognised as being best practice, then entry into the IMAP Managed Account Awards this week is your opportunity to have your peers recognise what a good job you're doing. And I'd encourage you to go to the IMAP website, imap.asn.au, and submit an entry into the licensee class, the innovation class, or one of the asset classes if that's appropriate for you. So Vinnie and Wade, thanks very much for your time today.
Great, thanks, Toby.